Monday covers 3 calendar days, not 1. It should pay 3 times what Tuesday pays. Instead, from 1953 to 1977, the average Monday return was minus 0.16%. Negative. Every 5-year block. Here's why. That is the whole paper in one chart. 4 days of the week sit above 0. Monday sits well below it at minus 0.16%, and French's own published figure was minus 0.17. So a rebuild on data anyone can download today lands within 0.003 of a percentage point. That is not a rounding artifact, and it is not one bad decade. The rest of this notebook rebuilds every table in the paper to work out what is actually going on and whether you could ever have traded it. The paper is Kenneth French, Stock Returns and the Weekend Effect, published in the Journal of Financial Economics in 1980. French sets up two competing models. Under calendar time, returns accrue continuously. The clock never stops. So Monday's 3 calendar days should earn 3 times what a normal day earns. Under trading time, returns accrue only while the exchange is open. So every day is one trading day, and every day should earn the same. Those are the only two sensible stories. And here's the thing, the data rejects both of them. We use our standard scientific Python stack, NumPy, Pandas, Matplotlib, SciPy for the distributions, and yfinance to pull the actual index history. We also fixed the sample window up front. 1953 through 1977 split into 5 5-year subperiods, exactly as French did. That split matters more than it looks. A result that only shows up in the pooled sample can easily be one unusual stretch of history doing all the work. Splitting into 5 independent blocks is how you find out whether the effect actually persists. French starts from the standard multiplicative random walk for prices. Take logs and you get the return used everywhere in the paper. R sub t equals the natural log of p sub t over p sub t minus 1 times 100. So it reads as a percent. The identifying assumption is on the second line. For any given day of the week, the expected return is a constant, and the error term epsilon is drawn from a stationary normal distribution. In words, every Tuesday shares one expected return, every Monday shares another. The whole paper reduces to a single question. Are those 5 numbers the same number? First, we pull the raw material, daily closing levels of the S&P Composite, straight from Yahoo Finance, running from late 1952, so that the first trading day of 1953 has a return. 2 details worth flagging. This index excludes dividends, which is exactly the series French use, so we are not quietly measuring something different. And the chart underneath is the whole sample, 25 years covering the 1960s bull market and the brutal 73 to 74 bear. Whatever we find has to survive all of it. Now, the step that makes the test clean, and it is the one most people skip. Under calendar time, Monday should earn triple, precisely because it spans 3 calendar days. But a Tuesday that follows a Monday holiday also spans 3 calendar days. Leave those in and you are no longer comparing Monday against the rest of the week. You are comparing a mixture of 1-day and 3-day periods scattered across all 5 columns. French's rule is to drop any return whose period contains a holiday. In code, that is simple. Keep a return only when the gap back to the previous trading day is 3 calendar days for Monday and 1 for everything else. Applying that filter leaves just over 6,000 usable observations against the 6,024 French reports. A handful of days differ because the exchange's holiday calendar in the 50s had some one-off closures that a simple gap rule treats slightly differently. That is a difference of well under 0.1% of the sample, and it will not move any conclusion. The bar chart shows roughly 1,200 observations per weekday. Monday has the fewest. Monday holidays are the most common kind, so Monday loses the most days to the filter. Table 1 is the center of the paper. For each day of the week, we want 3 numbers: the mean return, its standard deviation, and the t-statistic, testing whether that mean is different from 0. The t-statistic is the sample mean divided by the standard error, and the standard error is the standard deviation over the square root of the number of observations. Nothing exotic. We print French's own published figures alongside ours, so you can judge the replication yourself rather than take my word for it. And there is the replication. Monday minus 0.16 against the paper's minus 0.17. Wednesday and Friday both strongly positive. The black dashed line is French's published series, and our bars sit underneath it almost exactly. Look at the right-hand panel, because that is where the result lives. Monday's t-statistic is about minus 6.4. The 5% critical value is roughly 2. Monday is 3 times past it in the wrong direction. Tuesday sits on 0, and Wednesday and Friday clear the bar comfortably on the positive side. A t-statistic of minus 6 on a pooled 25-year sample is suggestive, but on its own it is not decisive. One abnormal stretch of history can drag a pooled average a long way. French's answer is the right one. Cut the sample into 5 independent 5-year blocks and ask whether Monday is negative in every single one of them. That is the claim in the abstract. It is a far harder test to pass than the pooled number, and it is the reason this paper is still cited more than 40 years later. 5 out of 5. Every block negative, every block significant at the 5% level, and the magnitudes are remarkably stable, clustered between minus 0.14 and minus 0.23, across 25 years that contain wildly different market regimes. Our 58 to 62 block comes in a little weaker than French's, at minus 2.4 against his minus 3. Every other block lines up closely. The pattern in the abstract survives an independent rebuild on different data, and that is the strongest thing you can say about an empirical finding. Means and t-statistics compress an awful lot of information into one number, and it is always worth looking at the distribution underneath. French's figure 1 plots the histograms directly, so that is what we rebuilt here. The comparison is Monday against the other 4 days pooled together, with the vertical lines marking each distribution's mean. The point is deliberately blunt. Monday's mass sits to the left of 0, and everything else sits to the right of it. 2 things stand out. The shift is real, but it is small relative to the spread. These distributions overlap heavily, and Monday is not some separate regime. It is the same bell curve nudged left. The gap between the means is about 1/5 of a percentage point against a daily standard deviation of roughly 0.8. That is the honest picture of the effect, and it is why it survives so long without being arbitraged away. A Welch test on the difference gives a p-value in the range of 10 to the minus 15. Small in magnitude, overwhelming in statistical terms. The subperiod test cut the sample 5 ways. The annual table cuts it 25 ways, which is about as hostile as this data gets. A single year holds only around 50 Mondays, so any one year is noisy. French reports that Monday's mean was negative in 20 of the 25 years, and that Monday was the lowest of the 5 days in 20 of them as well. If our rebuild lands on the same counts, that is a strong signal we have reconstructed his sample correctly and not just stumbled onto a similar looking average. 20 of 25 years, negative, matching French exactly. And Monday is the lowest day of the week in 19 of them against his 20. Look at the chart though, because it also shows the honest limitation. There are 5 clearly positive years in there, including a strong 1968. Any individual year is a coin flippish affair with only 50 observations in it. The effect is not that Monday is always down. It is that Monday is down far more often than chance allows across a long sample. Time to do this properly with a regression rather than a table of means. Equation 1 regresses the daily return on a constant plus 4 dummy variables flagging Tuesday through Friday. Because Monday has no dummy of its own, alpha is Monday's expected return, and each gamma measures the gap between that day and Monday. Now, the trading time hypothesis says all 5 days share one expected return. In this notation, that is a precise statement. Gamma 2 through gamma 5 are jointly 0. And a joint restriction on several coefficients at once is exactly what an F-test is for. The coefficients land right on the published ones. Alpha, Monday's expected return, is minus 0.16 against the paper's minus 0.17. Every gamma is positive. Every other day of the week beats Monday by between 18 and 27 hundredths of a percent. The F statistic is about 23 against French's 25, and the 0.5% critical value is 3.7. So we reject the trading time hypothesis at the 0.5% level. Days of the week do not share one expected return. Note the R-squared though, 1.5%. Real, but tiny. Equation 2 tests the other model, and the trick is neat. If returns really do accrue continuously, Monday's expected return is exactly 3 times every other days. So we scale the constant term by 3 on Mondays and by 1 everywhere else. That makes alpha 1/3 of Monday's expected return. And each gamma now measures the gap between that third and the other days. If the calendar time story is right, those gammas are jointly 0. It is the same F-test as before, run on a different design matrix, which is a genuinely elegant way to test 2 rival theories with one piece of machinery. And the calendar time model is rejected too, with an F statistic almost identical to the trading time one. But the chart underneath is the more interesting object. Both hypotheses are rejected in the first 4 subperiods. Every bar clears the dashed critical line. Then look at 73 to 77. Both bars fall below it. In that final block, neither model can be rejected, and French says so plainly in the paper rather than burying it. That is what an honest empirical result looks like. The effect is strong, persistent, and it weakens at the end of the sample. The test so far established that Monday is different. They say nothing about why. There are two candidate stories. The closed market story says negative returns follow any closure, holidays included. The weekend story says there is something specific about weekends. Now, these make opposite predictions for the days after holidays. Under closed market, every holiday return should be lower. Under the weekend story, a day following a holiday should be higher because it collects the holiday's own positive expected return, with one exception: Tuesday. After a Monday holiday, Tuesday swallows the whole weekend. This is the cleverest test in the paper, and the result is unambiguous. Monday, Wednesday, Thursday, and Friday all earn more after a holiday than they do normally. Tuesday is the sole exception. It earns less. That is precisely the pattern the weekend story predicts, and precisely the opposite of what a general closed market effect would produce. Do note the sample sizes in the last column. We are down to somewhere between 30 and 80 observations per day here, so these means are noisy. But the sign pattern is exactly right across all 5 days, and that is what carries the argument. Now the question everyone actually wants answered. Can you trade it? French devotes a whole section to this, and it is the most useful part of the paper. The obvious strategy is to buy the index every Monday afternoon, sell every Friday afternoon, and sit in cash over the weekend, skipping the bad day entirely. Ignoring costs, French reports 13.4% a year against 5.5% for buy and hold. That looks like free money. Then he adds transaction costs of 0.25% per trade, and watch what happens. And there is the lesson. Gross of course, the strategy is spectacular. Our numbers, 12.9% against 5.5%, almost exactly French's split. The blue line runs away from the gray one. But the strategy trades about 100 times a year, 2 trades every weekend, and at 0.25% each, that is a 25% drag annually. The red line is the result. It collapses below buy and hold in every single year of the sample. A statistically overwhelming anomaly with a t-statistic past 6 that is completely untradeable once you pay the spread. French is careful in the conclusion, and the reasoning is worth following. A negative expected return on a portfolio as large as the S&P composite is very hard to square with any sensible equilibrium model. But he points out that any test of market efficiency is simultaneously a test of efficiency and of your assumed model of equilibrium. So you can never cleanly reject efficiency on its own. His practical conclusion is the one that lasts. You cannot profitably trade this. But you can stop trading against it. Delay a Friday purchase to Monday. Move a Monday sale to the Friday before. The edge lives in the timing of trades you were making anyway. Everything side by side. Every headline number in the paper reproduces on data anyone can download today. The Monday mean, the t-statistic past 6, 5 of 5 subperiods, 20 of 25 years, both F-tests, and the trading strategy on both sides of transaction costs. Written in 1980 on a sample ending in 1977, and it still rebuilds cleanly 40 plus years later. That is what a durable empirical paper looks like. Thank you for watching, and I will see you in the next paper breakdown.